All right, why don't we go ahead and get started? So first of all, if you'd like to follow us on Instagram, you can. So Morningstar Investor AU. So yeah, give us a follow. The excitement on Instagram last night is I put up a post and I used the wrong then 3 times. So I had to update that in the morning. So lots of excitement on Instagram, including my improper use of words. Okay. Before we get started, we're going to talk about behavioral finance today, but let's spend a minute going through our housekeeping items. So anything that you hear today is general advice. I don't know anything about you, so I, of course, can't offer any personal advice. If you're over in New Zealand, you can go onto our website, morningstar.com.au, and get a copy of our FAP. And also, the New Zealand regulatory authorities encourage you to go see a financial advisor if you would like personal advice. All right, so today we're going to talk about behavioral finance, which I think is an interesting topic. We'll see how we go with this. I will say I thought that we were doing next week's webinar until about 30 minutes before that, before we went live. So talking about bad decisions. We're going to talk about decisions today, so that's a bad decision by me to not check that. Okay, so let's take a step back and look at different forms of economic theory, I guess is the best way to describe this. So traditionally, and this all will lead up to the efficient market hypothesis, which I'll talk about. Traditionally, when we look at sort of neoclassical economics and the way that human behavior was interpreted, there were a couple things that they assumed. Number one, that humans make perfectly rational, unbiased decisions. And what that means is a couple different things. Number one, that all information is available to everyone instantaneously. And then when we get that information, we consider all of it and we make the right decision for our own well-being based on that information. So if you go back and read sort of anything that talked about economics, this was sort of the underlying theory behind all the other economic theories, that you were assuming people were going to do the right thing. So everything from government interventions to sort of legally how we'll handle things, all assume that as long as people are provided the information, they'll do the right thing. Then we had this shift, the behavioral view of economics. So Daniel Kahneman, professor at Princeton, you probably heard of him, or maybe you've heard of him. He sort of introduced this field of behavioral finance. And this was saying that, hey, we don't make rational decisions. All of us are influenced by, as you see, emotional and cognitive biases. So the decisions we make are not, in fact, rational. And that if we want to approach things like investing or anything, we need to assume that people aren't necessarily going to make the decision that is perfect for them and maximizes their utility in the long term. So what does this mean? Well, if we look at the traditional side of things, this leads in, as I said before, to the efficient market hypothesis. So basically what that means is that security prices are always, or the prices of securities are always completely accurate, that they always reflect the underlying value of a company, if we're talking about shares. So when we see fluctuations in the share market, that is based on changing information. So that information, of course, comes out. We all collectively consume that information and make a rational decision on security prices, and then security prices will change as people buy and sell. So it's a nice theory. I don't believe it. I think if you spend any time with any people, you realize this isn't actually true. When we look at the behavioral side of things, what we've done and what the field has done is started to study the different behaviors that are the different influences that are going to affect how we as investors make decisions. And the thought, of course, is that if we understand that, number one, we can come up with ways to try to prevent people from making irrational decisions. And then also just publicizing this and understanding what these different biases are will allow us as investors, hopefully, to lessen the impact that they have on our own investing outcomes. So that's what we're going to talk about today. Now, way before the efficient market hypothesis even came out, we, of course, have our good friend Benjamin Graham. So Benjamin Graham, of course, wrote security analysis and then wrote The Intelligent Investor, and sort of thought of as the, founder basically of actual investing, at least the discipline of investing. So he literally wrote the first textbook on investing, which is security analysis, and then he wrote The Intelligent Investor, which is a little more approachable for the lay people. Not the world's most exciting book, but a good one to read. So he famously said, the investor's chief problem, even his worst enemy, is likely to be himself. So that's what we're going to talk about today. And we have a behavioral finance group here at Morningstar who spends a lot of time doing, first of all, going out there and doing tests to sort of see the different impacts of how we can make changes to, and I can talk about our own product here in Australia, but how we can make different changes to our product to try to encourage better behavior. And we're going to share some of their insights today. But first, why does this stuff matter? Well, this stuff matters because it will, of course, impact the returns that we get as investors. And this concept is known as the behavior gap. Now, what the behavior gap is, and the way that we can measure the behavior gap, is that we can look at returns between the average investor and the average fund. And we can study that to see what this behavior gap is. Now, what this means is, if you think about this, if we look at a fund return, we can go and look at a fund return, the return that a fund will have, which is agnostic to any flows in and out of that fund, right? Because of the way that a fund performance is calculated, we can basically separate that out from behavior. Then what we can look at is we can look at investor inflows and outflows into a fund. When do people decide to put their money into the fund, and when they decide to take their money out? And we can calculate what the average investor earned off their fund. And sure enough, there is a gap between those two things. And what accounts for that gap, the fact that investment returns are higher than investor returns, is of course our own bad behavior. Means that we are making mistakes, we are buying when we shouldn't, we are selling when we shouldn't. And we talk a lot on these webinar series and everything else that we do about how fear and greed influence investor decisions and make people do irrational things, like investing at the top of the market and selling everything at the bottom of the market. So this happens time and time again. You literally go back and look at every single bubble that has subsequently burst. And what is a great sign of the top of that bubble? There's a huge amount of money that flows into the market. And that's that kind of last leg up before everything falls apart. All right, so we did a study at Morningstar, I know the name of where I work. We did a study called Mind the Gap. So the gap, of course, is this gap between investment returns and investor returns. And what we do is we go out and look at this. So we do this every 6 months. And we go out and see if if there are changes in the gap between investment returns and investor returns. And so there are a couple of insights from this study that we should talk about, and they all actually make sense, but something important to think about. The more volatile the fund, the larger the gap. So what that means is the more the price of a fund bounces around, so that's volatility, the more that occurs, the larger the gap, meaning volatility, and this should make sense, security price movements, extreme security price movements induce bad behavior. And that, of course, makes sense. It's the same thing I was talking about. Prices start going up a lot. What do we do as investors? We get this fear of missing out. Everyone thinks everyone's getting rich but them. So what do? You throw all your money into the market. Same thing on the downside. When we have volatility to the downside, oh my God, it's going to zero. I'm going to lose all my money and live on the streets. I sell everything. So that is what investors tend to do. So volatility matters. The other insight is that during big pivot years, so basically a pivot year would be in between like a bull market changing into a bear market. So during these big pivot years, that leads to a larger gap as well. So kind of the same thing, right? So like as markets change direction, then then people make bad decisions. And obviously I don't know what's going on with the market, but I will say, and I think I've mentioned this before, that there is sort of this notion right now in all these investing chat boards, which I think I talked about on Tuesday, is that every time the market goes down a couple points, everyone starts talking about buy the dip. So this is kind of an example of this, right? So like as markets go up, and continue to go up, people are trained that every dip is temporary. And so that the best thing you can do, of course, is to buy that dip. Market goes down 2%, buy that, because as long as it's still going up, you will basically, after a while, become preconditioned to think that that's always going to happen. Problem, of course, is at one point, the dip is going to be the start of a falling bear market and not a dip, a plunge instead. And so obviously that behavior that has been learned will lead to really bad investing outcomes. So something to think about. All right. So let's use an example. Oh, and one thing I did want to talk about, a thing that Australians should pat themselves on the back for. Well, two things. Let's talk about number one, the size of this. So during the GFC, so the last, dip that became more of a dip. The behavior gap in equity funds between investor returns and investment returns was 2%. So that 2% a year. So that is a lot, right? So anybody that looks at a long-term time horizon, and this obviously was a time both those conditions were met. It was volatile and it was a pivot year in the market, went from bull market to a bear market. So both those existed. So this was a larger gap than the average, but 2% is a lot, especially over the long term. That can make giant differences in how much money you have. So something to think about. Now, the one interesting thing is we did this study in Australia, and it turns out that in Australia, the investor returns actually were higher than the investment returns. Now, the thought process behind that is because of superannuation. Obviously very different system because you cannot take your money out, except for some extreme circumstances, until you're 65. So investors are not exhibiting the same behavior, but that's great. But we can still think about how it could influence our own behavior, whether it is an account outside of superannuation, or if we just spend more time, and you probably do, since you're on these webinars, spend more time looking at your super account than perhaps the average Australian does. So something to think about. All right, so let's use a real world example. All right, so let's say you have 20 years until you retire. You got 450 grand in your super. You're adding a little over $7,000 each year. And we're looking at different returns. And the different returns we're looking at, so we're looking at 9% annual return, 7.45% return. So that is the behavior gap, like the average behavior gap, if we look over time. And then we have that extreme one, 2%, a 2% difference, which is that that GFC related behavior gap that we saw. So you can see here over a 20-year time horizon, huge differences, right? So it doesn't seem like a lot, right? The difference between 9% and 7.45 or 7%, but anyone that's spent any time playing with the financial calculator is well aware of what the differences is. And so you can see here, huge differences, right? 2%, that means you have more than $800,000 less dollars after a 20-year investing time horizon. So I, for one, would rather be up here than down here. Now, obviously, who knows what these returns will be, but the point is that difference, right? That difference still represents a pretty big number. So yeah, good real world example. All right, so we're going to go through a couple of the different biases that impact investors and talk about why my slides are out of order and talk about what these actually mean. So let's talk about confirmation bias. So we have a quote from our good friend Warren Buffett. If this was on our podcast, we would now be drinking, but we save that for the night webinar. If anyone wants to sign up for that, we're doing one tonight at 6 p.m. If you enjoy watching me drink. you can sign up for that. But we got this quote from Buffett saying what the human being is best at doing is interpreting all the new information so prior conclusions remain intact. So what does this mean? It means once we have a viewpoint, and we can see this in all sorts of things, not just investing, whether it's a political viewpoint or a viewpoint about, almost everything. Once we have these viewpoints, people go out there and seek out ways that all new information are actually going to confirm what they already think. So we're not very good as humans of going out there and reading something, right? This sort of rational idea, reading something and changing our mind. So what we'd like to do is go out there and find a bunch of facts that confirm what we already think. So not a great thing for an investor. And we've seen this happen more and more, especially around obviously around the fact that the internet has allowed people to sort of segment themselves off into kind of little tribes that believe the same thing. We've seen this a lot in the media landscape, as instead of having, one paper that everyone reads, all of a sudden we have a paper for people on the left and a paper for the people on the right. And, once again, we're just going off in our little tribes and only hearing stuff that actually reinforces our opinion. But from an investor standpoint, what do you want to do? Well, with a lot of this is sit down and come up with an argument of why you were wrong. So for anything, so whether you are looking at an individual stock, I'm buying BHP because I think it's a great company. Come up with all the reasons why BHP is not a great company. It's going to be a disaster of an investment. All sorts of ways we can do this and write the stuff down. And going through this exercise, what it should do is it hopefully should reinforce why you think what you think in the first place, if you're right. But if you're not, it can obviously open your eyes to opposing viewpoints. So, walk a mile in someone else's shoes. All right, overconfidence bias. So overconfidence bias, we've got Warren's good friend, Charlie Munger here. We see this all the time. So we see this obviously, like the example that everyone talks about is driving. That you go out there and you talk to people, how good of a driver are you? And like 80% of them say that they're above average. And we know that's obviously not true, right? Can't all be above average. Overconfidence bias. So what happens? How does this impact you in investing? Well, a lot of it impacts you at the top of the market, right? Where all of a sudden you are very, very confident that you are right about your opinion and you take on too much risk. So that's generally what people do. So they can happen at the top of the market. It can be putting too much of your portfolio in one share, for example, that you are convinced is going to take off. We see all sorts of different impacts from overconfidence bias. So once again, and a lot of these examples are the same about how to combat this stuff, is imagine the consequences of you being wrong. So if I put 50% of my portfolio in some micro cap stock, what happens if I'm wrong? Well, it could mean that you'd have to work an extra 10 years, for example. So just imagining a scenario where you're not right will hopefully allow you to dampen the risk that you're going to take a little bit so that you're not being that extreme. So overconfidence bias. Action bias. So this is the traditional fight or flight mentality that humans have, right? That we feel like we need to do something all the time. And, I'm obviously no behavioral psychologist, but, going back to caveman days, you probably did have to do something. So, some saber-toothed tiger shows up, you probably do have to do something. But with investing, action generally leads to worse outcomes. So we know over trading is a very bad thing. We can see this very specifically in that behavior gap. What are people doing? They are chasing returns. You have a year, Fund A doesn't do as well as Fund B, and everyone decides they're taking all their money out of A and going into Fund B. And we can see this. People chase performance. And that, of course, is action. I need to do something. The fund that I'm in underperformed the market for 1 year, even though I'm a long-term investor. Everyone keeps saying they're a long-term investor. They just don't do it. So I need to do something. What is it that I'm going to do? Okay, well, I'm going to switch to a better fund. So as investors, a couple ways that we can combat this. Once again, just knowing the fact that more you do, generally the worse outcome you're going to get. Now, this shouldn't be, obviously, it's not this do nothing, but think about that before you make any decision. And the other thing, of course, we can do with action bias is put some structure around our investment process. So it's what we preach a lot here at Morningstar around goals-based investing and all of those various webinars and podcasts and tools that we have on our website that we have are trying to put some structure around that. So why am I investing? I'm investing to meet a goal. What do I need to do to accomplish that goal? I need to get a certain required rate of return. So how should I judge investment decisions? Based on that required rate of return, and sort of tracking that over time. So putting those structures into place to stop you from exhibiting an action bias. And of course, I like Animal House. I think it's a good movie, but yeah, I've got a good quote from Otter, and yeah, this is of course they are responding to getting put on double secret probation by the dean, but it's the same thing. Like, what do we do? Well, let's go out there and do something outrageously stupid. What should we do at the top of the market? Let's put all of our money into some penny stock. So same concept. All right, longer quote, recency bias. So I'm not going to read this whole thing out. You can read the quote yourself. But yeah, basically, and this is the same notion I was talking about with buy the dip, is we have very short memories. So, it's funny, like people like me always sit around and talk about all the new investors that have come into the market since basically since the dip in March of last year, kind of the COVID dip. All these new investors, and particularly even people that have been investing now since the GFC, right? So you could be investing 10 years. You've never really seen a bear market. Saw what happened in March. That was a bear market, but at the shortest recovery time frame of any bear market ever, it was a bit of a blip. And so recency bias, as I said, people always, like me, talk about how these investors have never seen a downturn. But even people that have been investing for very long times and gone through multiple bear markets and very serious bear markets, still you are more influenced by recent behavior. And this is also true around, of course, investment performance. That's why we chase performance, that you're influenced by what were the returns last year. They were really good in this investment. I'll move all my money into this. I think what's important to combat recency bias is a couple things. Number one, taking a very long-term perspective. And as an example, I talked about, behaviorally sort of what, how it's influenced our products here at Morningstar. Like if you go on to premium and go on to our monitor markets page and look at the top performance charts, we default them to a year, right? So instead of a day, we default them for a year. So, and I would, as an investor, go back even more and just look at market history, and you can realize things like, okay, if the market is falling significantly, realize that at every other point in history, this turned around. So stop fixating on what has just happened and look longer term. So yeah, take the long view. All right, information bias. So this is something that certainly has been an issue recently, once again, to blame the internet, is the fact that we are bombarded and inundated with information these days. So we get data everywhere. You get push notifications on your phone. It's all over the internet. It's sent to your email. All of this data, all of this stuff that's coming out, most of it doesn't matter at all. So most of the information that we are getting around share prices will have no impact. Some does. And it's very difficult to sit there and figure out what are the bits of data that actually are valuable. But what does information bias do? What does constantly getting bombarded by information make us do? Well, it helps to exasperate action bias. Right? So it's just the way that investing is even portrayed. Any movie or TV show you watch, it's very much the trader mentality. They're yelling into two phones and typing at the same time. Investing is supposed to be boring. Unfortunately, at the end of the day, as exciting as we'd like it to be, it is supposed to be boring. Think of all the ways that you actually have investment success over the long term. Well, most of them are just compounding, buying stocks at reasonable prices, collecting and reinvesting dividends. Those are all the actions that lead to good investing outcomes. Sticking with a fund or a share if it's fallen, because reversion to the mean is a real thing. All of those things are what lead to good investment outcomes, doing less. But all this information that we're constantly getting pounded with can induce you to do bad things like trade too much, chase performance, things like that. All right, anchoring bias is a good one. So anchoring bias is the tendency that we will anchor or rely too heavily on a past reference point. Now, in investing, a very key past reference point is price. So we anchor a lot to price. We anchor to portfolio value. So, an example of this is that if your portfolio has $100,000 in it and you've worked very hard to hit that point of $100,000, and then the market starts falling, all you're going to think every day while you sit there and look at your dwindling account is that you used to have $100,000. And what has happened? Well, you were an idiot. You should have sold everything at $100,000. You'd still have it. As you watch that account go down, that induces people to sell. And of course, that's a bad idea. Same thing with individual shares. People fixate on prices, and I do this sometimes. That I mostly fixate kind of on the downside, which I told the story before, which sort of cost me during the COVID fall, that I, for some reason, had this fixation that I think it was MasterCard that I wanted to buy, that if it got under $200 that I would buy it. And I think if the $200 is correct, if you look at the chart, it got to 201 and now it's way up. And it's an example, for some reason, $200 did not matter in any way, right? From a valuation standpoint, like you guys, of course, can do math. It was something like 0.5% away. None of that would have mattered. And for some reason, I just anchored on this number saying it gets below 200. I'm going to go out there and buy that. When in reality, what I should have done is I should have taken a step back and said, okay, I think it's cheap. Is 0.5% going to matter anyway? Of course not. So I should have just bought it when it was in the cheap category, realizing that if my thesis about MasterCard was correct, 10 years from now, I wouldn't even remember this, and that 0.5% would be meaningless. So that is anchoring bias. So we do that with prices. We do that prices even selling things, right? So if we know what our cost basis was on a certain share, like the fact that we have, a huge aversion to loss, that we just are waiting for it just to get a tick over what you paid so you don't have to say that you lost money on it. Another example. All right, we did it. But anyway, thank you guys very much for joining. I appreciate it. Today was a shorter session, but if people do have questions, you can email me at mark.lamonica1@morningstar.com. Thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.